don't do it alone. This is
Yeah.
not M&A is not cheap. It is not a cost. It is an investment.
Mm-hmm.
And I think a lot of people are confused or forget that this is you're investing in an investment. And
Mm-hmm.
for buyers, I've lost count of the number of times where they've been uncertain about spending maybe $15,000-$20,000 to assist with buy side diligence, and I'm sitting here thinking you're about to take out $4 million in debt. That's
Mm-hmm.
I mean,
You're
do you want
literally
to
going to
risk? I
mortgage
mean,
your
so
family's future.
you're not going to invest in one extra month of debt service to get a better understanding of what you're getting into.
Yeah.
Mm-hmm.
You're
Right.
not a good fit for all parties. I don't, and I get, look, I get closing costs and I get the funding
Mm-hmm.
piece of it, but I see that on the buyers, and it's the same thing with sellers. I mean, Jake, how many sellers are like, I don't want to hire an investment banker. I don't want to pay them X%. I'm like, why would you not
Yeah.
entertain someone?
Right. Right.
If who can find you a
Right.
good fit and get this done, and then do it for you.
Welcome to the How to Buy or Sell a Business Successfully podcast. The concepts discussed in this podcast are for informational purposes only. No attorney-client relationship is intended or formed by this podcast. No legal advice is intended in the substance of this podcast. Feel free to check out our website, www.goforemanlaw.com. Enjoy the show and welcome your hosts, Jake Wayman and Sam Foreman.
All right, welcome back, everybody, to How to Buy and Sell a Business Successfully podcast. I think we're at episode in the 40s now. I can't believe we actually got this far.
We're not dead yet.
Yeah, we're still here. But my name is Jake Wayman, and I am my wife and I are the proud owners of the Orange Theory Fitness Studios here in Wichita. I also am a fractional business development executive, working with companies, helping them grow their top line revenue. I'm working with an investment bank out of Oklahoma City called Infinity Capital, and then also my family's company, Citywide. Do wear a lot of hats, but enjoy all of them. So having a lot of fun with it. But the best thing going on in my life right now is my 4-year-old. I think he comes home from school with a new Band-Aid every single day. And the kid never wants to take the Band-Aids off because he will scream because he thinks it's gonna hurt even more. And it's interesting. This latest one was the best one. He had his popsicle at school, and he was sitting on the park bench or whatever and fell off the park bench. He saved the popsicle though, but he skinned up he skinned up his knee pretty bad. So I know, but that's what's fun in my life is what does Jax come home with today?
Nice. Well, I'm Sam Foreman, founder of Foreman Law. Our firm focuses on mergers, acquisitions, buying, selling businesses, other ownership transitions, and business law. One of the best things in my life right now is my son Jackson, who's 7, is learning how to read. And for any of our listeners that have dyslexia or have children with dyslexia, seeing your kids make progress on reading is it's a wonderful feeling. My wife walked into his room the other day and he was reading one of his favorite books to himself. And I'm not going to cry in the air. But that experience, man, made my day.
What's his favorite book?
Dog Man, of
There
course.
you go.
Of course. Yeah. If anybody's not familiar with Dog Man, you need to check out a copy of this epic literary tale. It is extraordinary. We're really grateful to be joined by Sean Kennedy from Adams Brown. Sean focuses his work on the M&A advisory side of things. Really does a great job helping clients prepare for the transactional process. He's a very relational guy. Really uses his network to help his clients as well as his expertise. Sean is based in Kansas City, but serves clients over a wide geographic range. And Sean, we're just really grateful to have you here today. Tell our listeners a little bit more about yourself and the work that you do and what's one of the best things going on in your life right now.
Awesome. Well, hey, Sam, Jake, thanks for having me. Really appreciate you being on here, and this is going to be a lot of fun. We might have to keep our language to be mind our P's and Q's here and keep it going forward professionally. But you guys, you did a great introduction. My name is Sean Kennedy. I'm a licensed CPA by trade, but an M&A advisory by just kind of happenstance and by passion these days. So I'm with Adams Brown CPA and Advisors. We are one of the largest firms in the state of Kansas, one of the largest in the region. Mind you, as well, full service. Our specialty is audit, tax, outsourced accounting and consulting, the advisory services, which we'll touch into here a little bit as well. We also have a managed IT services arm, our own wealth management group, probably going to add a lawn service here pretty soon at the rate that we're going.
Excellent.
We're just trying to capture everything that we can and really have a strong footprint both in Wichita, the state of Kansas, the region. I'd say our target audience is the ones that listen to this podcast and others. It's really fun. It's really fun to be very hands-on. And I come from a background where I spent prior to joining the firm in 2020, worked for bigger firms, including Big Four. And, while it was fun travel, it was fun. You got to work with some really cool brand names. You're always just one piece of a 10,000 piece puzzle. Whereas working in the community, working with kind of that lower middle market, it's really, you got to roll up your sleeves and really add some value to your clients, to your community, to the stakeholders. And it's just much more rewarding overall. Not everything is great. There's certainly the cons that come with the pros, but I'd say at the end of the day, the net is really, really been fun and really rewarding. So as mentioned, that's the firm. I currently lead our advisory services practice, but really with an emphasis on our M&A transactional group. What is advisory? We say pretty simple. Our clientele and target market it's not a construction company. It's not a manufacturing group. It is companies looking to buy, looking to expand their operations, or they're looking to sell either to a third party or to an internal member through a succession plan. How do we help with that process? Well, we don't have 4 hours, but I'll be pretty quickly. We specialize with doing business valuation services. We do M&A advisory. Do dovetail a little bit into the litigation support space. I got to do a quick plug for that, just given my background. But really, our emphasis is working with transactional-based companies looking to buy, looking to sell, or looking to expand their operations, and then just trying to help out any which way we can, given the needs and circumstances.
Yeah, no, that's terrific. What's one of the best things going on in your life right now?
Since we're on the topic of kids and we're all living the same life, I have a soon-to-be 6-year-old son whose birthday is actually going to be the 31st of May, and a 3.5-year-old son as well. Jake, I hear you. The Band-Aids, it shocks that how much those help with pain. I had no idea that Band-Aids help with pain, but
they do.
Lesson learned: if you don't want to rip it off, just the bathtub's a great place to naturally fall off. So yes, there's a freak out and there's some probably drainage issues, but easy way to resolve those concerns. Gotten very, very surgical with my own rights and applying Band-Aids. And but it's fun. They're out of school now, which is really fun to be around them more often. And, the other day, you talk about independence and learning, Sam. I was downstairs. My wife and I work out every morning in our basement, and he now has learned to make his own juice. And the other day came downstairs and offered me a glass of juice with like an umbrella straw, well put together.
No way.
That's great.
5.5 years of waiting on your worthless, it's nice to get some reciprocity finally back.
Did he ask for a tip? Because they don't get taxed anymore.
Yeah, that's awesome.
He actually sent me, actually the square reader said, what gratuity do you want to use? And I did 18%. I didn't do 20. Wasn't quite to my standards here, but I thought he did a better job than the 15% standard.
That's
nice.
Awesome.
Dude, that's awesome. Way to go. Well, one of the things that you and I've talked about a little bit before, but would love to kind of get your take on is sort of how you see the M&A market developing and sort of some trends and sort of the Kansas City region. What's sort of unique about it? How does it, seem to be shaping up? And what are some things that you've noticed kind of from how that market, where it's at and how it's developing right now? And maybe start by, explaining what you consider the Kansas City region to be.
That's a good question. And really for me, and it's funny, we reside in Overland Park, but yet I've always viewed it's the Kansas City metro area. And I'm going to say that's really as far west as almost at this point, almost getting to Lawrence, not quite there.
Yeah.
And then I'd say, spanning into the Missouri side, probably halfway to Columbia in some regards. And it's a huge footprint. And then you tack on that St. Joe's is a couple miles north, and that footprint. And then Omaha, once you get out of the metro, is really 2 hours away. And, maybe a recent trend is the mergers of FNBO and Country Club Bank, to the longest standing legacy institutions in the Midwest. And really, in a way, I mean, are we going to be connecting Omaha and Kansas City in some capacity? And that remains to be seen. And that's, to me, the definition of the metro. And Kansas City has always been a unique market in terms of the opportunities and the service, the products and services, and the companies that have been there. And it's a wide range, but ranging from traditional small companies to, in many cases, we have our share of some Fortune 5 publicly traded organizations. And well, at least we did before some mergers that took place, but you still have some of that footprint. And Kansas City has always been, in my opinion, the chief crop, so to speak, when you think about what cities are known for, what they hang their hat on. Where Kansas City really stands out and has for years is it's always been a great platform for outsourced professional services, specifically in the form of engineering and legal and consulting talent that can reside in Kansas City and service the entire country, or in some cases, the entire world. A good, whether it be through Cerner and how they evolved in the EMR platforming and how they're able to grab really talented consultants from local schools and build them up to be successful and eventually create a platform where they can merge with Oracle. A huge transactional hub in the legal space with big firms such as Polsinelli and Stinson and Shook Hardy and Bacon, and even trickling down to the Brian Caves, to the other organizations there as well. A lot of the value prop is we can be so much more competitive with costs by offshoring services from the Bay Area, from New York City to other big metro areas to the Midwest, all while still providing a great quality of life, great careers, and we can operate with good, talented, strong professionals. That's always been an institution. And then you factor in the engineering space, the architectural footprint, and it goes on and on and on. And I think that's a good segue into what I'm seeing, Sam and Jake, where that's always been, to my felt, where Kansas City has really hung their hat as a city, and where they really flourished economically and professionally. We can provide a great community for talented, educated professionals to thrive, to succeed, to do great work that is rewarding, make great money, and live in excellent communities with good people, great schools, and just a great quality of life. It's why we've always consistently attracted either boomerangs, people that grew up in the area, that moved to Chicago, that got married, had kids, had that calling to home, or New York City. I mean, we used to live in Brookside, Missouri before we moved recently. And I think during COVID, we had 5 or 6 people move back from New York City. And it's just like, why are you moving back? And they go, well, we had kids and we could keep our jobs, work remotely, and we were able to, keep our New York salaries, but live in the Midwest with our families. It was a no-brainer. And you're seeing a lot of that's gone on. But where I want to go with this is that's always where I felt the talent has been. And what I think is unique about the M&A space, not just in Kansas City, but I'm going to say even the entire Midwest region, ranging from whether it be Wichita to Oklahoma City to Nebraska and Iowa, is what I've seen recently. And what's really encouraging is the continued infrastructure and development of professionals who are experienced and capable of handling M&A transactions in the Midwest, from soup to nuts, across multiple platforms. There are now, it's no longer just, I always say, it's no longer guys that look like you and me that live in New York City wearing a gray vest to work that just do M&A. It has become a common business practice. And you think about what's evolved in the Midwest, we now have law firms such as Foreman Law, who can handle M&A transactions for buyers, for sellers, for different industries, different sizes, different circumstances. We have CPAs such as myself who can advise on everything from tax to accounting to valuations to just understanding deal structures to just giving good advisory services concerning businesses and their operations. We have investment bankers and brokers such as Infinity Capital that can now successfully market and sell companies in the Midwest to either other Midwest investors or across the country. We've always had a strong wealth management footprint here. We've always had a good lending footprint here. And last but not least, we're seeing an uptick in private capital that is being housed and invested within our backyard. That was often, seemingly every year I hear more and more private equity groups being formed. The family office space has exploded. You're seeing more independent sponsors and rising to that level. You're just seeing more money being invested and being deployed in this market. And subsequently, we have better representation from a professional side to ensure these deals are getting done well, and that all parties benefit with the terms and circumstances.
Yeah. Well, and so you're talking about, we've really within the Midwest, I'll loop all this into the Midwest, is, really creating the landscape for successful M&A to happen. We have the service providers, such as all of us here in this room. We have, in the outside of the room, we have the environment that we don't have to go to Dallas or New York City or Chicago to get it. We can have it done right here. So let's flip it around and actually look at the sellers, because in your line of work, you're dealing with sellers, from infancy, getting started, from a founder getting their business launched, to them scaling it, because you're working with their books, advise them through the process. So, the question would be around, what steps are you using as Adams Brown? What are sellers doing 2 to 3 years out to maximize the value of their buyer? So when they do want to engage a good service group to, make that transaction, what do they need to be doing, 2 to 3 years out for that happen, for them to be prepared for that?
Nope. And that's a really good question, Jake. And you're correct. We work mostly with sellers. We do some buy-side advisory. We don't shy away from that space, but historically and going forward, we are seeing more need and more demand to assist on the sell side. And really, where I always start with what are the right steps to take with 2 or 3 years out. And let's just start with why it's important to start 2 or 3 years out. And this is something that, when a good analogy for selling a business, this is really the professional equivalent of taking a final exam or studying for the bar or a CPA license. Oftentimes what it comes down to in concerning success is how much time and effort did you put into preparing for the sell? How much time did you study? How well prepared were you to sell? Is that the only factor? No, you need a profitable business with good people, good revenues, good concepts, good cash flow. Just like to take the bar, you need to be smart. You have to understand law. You have to be educated. But when we think about in times in our lives when we've gotten a good grade on something or a bad grade on something, it oftentimes comes down to how well prepared were we. And that's how we view an exit, and how we view an elongated 2 or 3 year time period. You're giving yourself time to study for the exam so you get a better grade in the form of a better term.
Yeah.
So where we always start with companies and owners and kind of what are the right steps to take. The first one, and I say this kind of laughingly, is you have to commit mentally and emotionally. I've lost track of the number of times when deals have fallen apart, or we get halfway through where a seller just gets cold feet because they were never certain. And it's a lose-lose for all parties. So I always say, before you even start going down this path, just in your head, are you mentally prepared? Because there's a lot that it's a long journey that comes with it. If you're mentally prepared, you don't have to be ready to walk away tomorrow. But as we know, it takes a long time to fully exit your business. It can take a couple of years to get it ready for sale. It can take up to a year to get a deal closed. And then depending on the terms of the deal, it might take a couple, 3 years for you to execute an earnout and get out the door. So if you're wanting to retire in 3 years, but reality is going to be, 8 years, that needs to go into effect with your timing. So the first step is, are you committed? The second step is, okay, now that you're committed, do you have a good understanding on who the right buyer would be? And that is a step that can be done independently. It can be done with the use of a third party. This is a great place to consult with investment bankers or brokers, for example. It's, hey, this is what I do. This is who I am. Who is the right buyer? Some situations, a third party sale to a private equity organization is going to be the best fit. But in other situations, it might be more realistic, or in some cases, a preference of the owner to sell to a key family member, to a key employee, maybe a customer or a competitor, or maybe some combination of family and a key employee, or they want to execute an ESOP on the back end. That's important because both paths can be very different. The valuation methodology can be different, and just the goals and objectives can be different.
Right.
So you have to commit, then you have to understand who's going to buy this company and why. And then the third step from there is, now that I have that put together, get a valuation. And what we always want to look for, and what we call this is a great time to talk to a wealth advisor or someone in your group to say, hey, we call it your happily ever after number. Like, what number do I need to sell and walk away with after tax, after my debt service, after my working capital considerations, after I've paid all the sharks in the water that are helping me advise on the deal? What's left?
Friendly sharks, by the way. Yeah.
Friendly sharks. But we do smell blood, it's crazy, but we're friendly sharks. But once that's done, is that enough to live off of? And that's, we always talk about that, is we can reverse engineer a sales price. I need to know what number you're happy with to walk away with.
Right. And then you got to figure out, like you said, is it the right number? And then help them understand, like, hey, how far is that number actually going to take you? And then based on the sales price and what kind of buyer you're looking at, what's going to be the composition of that purchase price? Like, how much cash are you actually reliably getting? Because you get earnouts, you get rollover equity, you have escrows and all that other stuff that's at risk, sometimes substantially at risk. You may never see any of that money. I mean...
Well, and in the kind of that point, it's like it's establishing what their goals are early, because if you know their goals are, now that limits, you can now say, okay, these are the type of buyers we want to go after. So if their goal is, cash up front, with no rollover equity, or they don't want to stay on very much longer after that, now we're going to limit what we're going after, what we're talking about. But if yours is to, you see the potential in this business and you need to come alongside a private equity group to scale it even more, that's a different story. Now you're talking about a different type of buyer you're going after. But it really is, I think it's, you're spot on, is like, it's starting with the end in mind, really talking with them early and saying, okay, what do you want to gain out of this? What are your goals?
Right. Sean, I've got a question for you. Like, when you think about some of these long lead time, value drivers, like let's take customer concentration, for example. Like, if somebody's looking at a business and the customer concentration is, hey, I've got, 60% of the, the revenue is tied up in these 2 or 3 customers. I mean, that for a lot of people is going to feel like a really heavy concentration. And your seller, identifies that that's a risk that's going to come as a knock on valuation, and they need to change that to sort of lower the risk, raise the value. How long does something like that take to realistically be able to change, short of firing them and destroying your company?
It's a great point, Sam and Jake, and I'll tie this back. Again, this is the next step in our steps, right? We have committed. We have identified the right buyer type in the right situation. We have received our valuation, and you both were dead on. That value will be contingent upon many factors. It is going to be age. It's going to be where you are, the nature of the company. All those factors. Sometimes we have clients who are like, hey, I'm valued at X multiple. Well, I think I can fetch this. And we come back and say, well, if you're going to command a premium, you have to understand there's fine print on the back end. A buyer may want to capture that premium through some sort of unique arrangement. I'm not saying it will happen, but just be aware of this. But once we've had our valuation, then the next step, to your point, is going through your exit planning process. And tying that to your question, Sam, around the value in these areas of concern, there are 3 drivers of value when you in valuation methodology, when you are valuing a business or an entity or an asset. It is growth, it is cash flow, and the biggest driver of all that people forget is risk. Risk is formed and typically shown as a discount rate or a cost of capital, or in some cases an EBITDA multiple. And that driver alone can oftentimes create the biggest swing in your valuation. It is why next time you guys drive up the turnpike, and you'll see every gas station is a Love's. Love's came in and bought everything up. Apparently, it's become a hot commodity. And why do people covet gas station acquisitions when they make 15-20% margins sometimes? Well, think about how much little risk there are compared to other ventures. You don't need a PhD to be the GM. It's business to consumer. It is all cash flow positive. You're selling Slim Jims and lottery tickets and gas. No, there are, you can't just, it's on an autopilot. But compare that to your point to, I have one customer who represents 80% of my revenues, or I have this key person, or I can't hire in this location, or I've got all these other risks that come, I'm carrying or I'm carrying all these AR or this whip through a project. All those factors can create risk and discounts, even for companies that are very profitable. So it's a huge area. So where we look at it from a risk factor, and to your point around the exit plan, there are three fundamental elements that are embedded within every single exit or plan for sale that are intertwined and are very, very important. There's business improvement or business readiness. And this would be if a company's performing at margins, say, EBITDA or gross margins that are below industry standards, and there's some room for improvement. Are there areas within the business maybe that can be fixed either quickly or through a strategic investment, whether it be better equipment, better capital? Are there any key employees that could be hired? Are there any, is your software outdated? Are there all those factors? And that's not an area that I'm personally very, very well versed in when it comes to certain industries, but that is one area. And that's the area where a lot of businesses tend to focus the most. And while there's upside, there's also oftentimes too can be, are you forgetting about things that are just as important, but might be easier to fix? And it's just like if you're selling a home, yes, putting in a pool is going to maybe add more value than fixing your foundation. But can you sell your home with a cracked foundation? They are all intertwined. So there's the business readiness piece of the leg. The second piece, and I'll cover quickly, it's the most important, is the personally ready. Are you ready for life after? And we address that with the you have to commit piece. I bring it up. It's one of the legs. It is important. But the third area, and this is where I have been focusing recently, and where we'll be focusing extensively going forward, and it's such an important piece of this. Are you prepared to communicate, and are you ready financially in terms of, do you have your books and records accurate, ready, and presented in a way to share with a buyer so that they have few questions? They're not going to come back with more questions to answers. It shocks me, Sam and Jake, how many companies get under letter of intent and we see buyers back out because the accounting's wrong. They don't reconcile. They can't prove out their cash. They've been performing on an income tax basis because they don't need an audit or a review, and they're furnishing financials where they're writing off all of their inventory. They are not capturing their backlog. They don't have details surrounding, hey, I sold these products to these customers and these are the associated costs. And and I don't have documented process and procedures around how I screen my vendors, or how I make money, how I manage my people. I haven't thought about the question, hey, what's going to happen if you leave the business as the owner and you're the top salesperson?
Jake and Sam here.
Thank you for joining us. If you find this content helpful, please like, subscribe, share it with a friend, and especially leave us a 5-star review on Spotify or iTunes. Really helps us out a lot.
Yeah, 1 star, it's on Sam.
Yeah, it's definitely on me.
Yeah, no, 100%. I mean, we talk to folks all the time about transferability of value. Like how transferable is that value? And like, to your point, if you're the owner and you're the top salesperson, and I mean, your buyer's going to figure that out in due diligence, and they're going to go like, hey, those top 4 clients, those are your golf buddies. They're not my golf buddies. Like, are they going to keep buying from me? Do you have long-term contracts that you can assign to me that's going to persuade me that I'm going to continue to be able to earn their business, or even if they are like 2 to 3 year contracts. I'm not buying this because I want it for 2 to 3 years and then want to find out what happens next. But if you've wired your business to be so heavily integrated with your own personal DNA that it's inseparable, I mean, you might not have something that a buyer is going to be willing to pay, the same sort of price as just continuing to earn it and benefit from the cash flows, which is seldom going to put you in a position to earn top dollar for the work that you've created with your life.
Exactly. And it is, in my opinion, the most overlooked and yet most important aspect of an exit and when you're prepping for sale. It is, I want to say comical, but I remember one of the more empowering conversations I've had in the last 6 months. I was talking with a friend of mine who's with a big private equity group in the region, and we were talking about exit planning and just kind of some best practices and just talking about just how many clients we see, or companies, dare I say, not even our clients, but companies that just don't have books and records. They're not prepared to communicate they're not willing to represent their business underlying operations. And he came back and said, this should be expected. It's an expectation that you should have all this put together. You should have documentation. You should have your goodwill infrastructures and memorialized. And yet he's like, when we ask a seller for their information, and if they can't provide it within 3 or 4 weeks, we get cold feet. It tells me they're not mentally and emotionally, they're not prepared.
Right.
They're not ready
Right.
to talk to us. And that says a lot about them first impression. They have to sell themselves to a seller, and a seller has to sell themselves to a buyer. And a buyer's not looking to come in and, shark you at the table. They're looking out for their best interest as well. They're looking out for their investments. And many times, as we know, it's rarely the buyer that's the problem. It's the banks. It's got to go through underwriting.
Right.
Or in many cases, if there's reps and warranty insurance involved, they can be even more scrutiny in terms of the underlying operations. I mean, you got 3 bosses sometimes to go through to complete this exam.
Yeah.
And they're sitting here and like, look, we have a $40 million check or a huge check that we are wanting to write to a seller. And it's the first company that has their together that can get us their information. They're going to get that check. And he said, forget focusing on improving performance. He's like, just having information prepared. And it's not just financial statements, but are they adjusted for book purposes? Do you have working capital presented on your balance sheet? Do you have your adjustments documented and substantiated so that we know truly what the normalized earnings are with a business? Do you have your customer details? Are you prepared to speak about your business? So just having that alone will drive value because it'll expedite a deal. Companies that are being sold are probably profitable, right? Like we can weed out the clients who are like, or the companies who are like, hey, I want to sell. I'm like, yeah, you can't. You have losses. There's all these holes. You can't do this. Companies that are going to attract a buyer are probably pretty good. So it may not come down to just how good are you, but rather, are you prepared to go through the process? Can you speak about your business? Can you accurately represent what's going on to a buyer? What should be, these are unforced errors that can be captured 2 years in advance. It's an open book test. All right. We know what questions a buyer is going to ask because we get their request lists all the time. So study the requests, get your information put together. If there's areas for improvement, great. Otherwise, just be transparent, have it ready, and you will capture potentially, it can be a 6-7 figure value prop if you have it that way.
Right. Yeah. No, that's great. I think this is a good time for a question from our audience. Kristen Kienzle has a question where she's asked, what are the expectations of a seller as far as committing to stay with the company for a period after the sale? And so you talked earlier about being mentally ready and personally ready, but then also, sometimes that sort of transition period plays in. But what would you say in response to Kristen and her question about what the expectations are of a seller as far as what they're going to do and how long they're going to stick around after the sale?
That's a good question, Sam. And I'd say for Kristen, really where we see the two buckets, or two scenarios where we see some sort of earnout period. It's scenario one would be if a seller is wanting to sell their entire business outright, but there are key circumstances that would warrant them to have to stay on board for some sort of earnout period. Mm-hmm. It typically is a best practice. In many cases, it's smart to do. It's a sign of good faith for anything else, especially for a lot of the clients that we work with in our communities where the buyer profile, it is, they need someone to come in and help them show the ropes, understand what to do, and make some key introductions. That is just a sign of good faith. I would always advise a seller to offer a little bit of time to transition the business. Anything beyond that, it's going to be tied to what are you selling? If there is a lot of personal goodwill, meaning how much value does the business owner have that is standalone to the business, and or how much of the business's value is comprised of goodwill. Goodwill being, this is intangibles. It's your people, it's your process, it's your software, it's your tech, it's your leadership. If that is well structured and can continue going on, your earnout will be of a lower amount. If there are some areas of concern or some items to address, you mentioned customer concentration. That is typically going to be supported by some sort of elongated earnout period, and the seller would then have an obligation to transition relationships, whether it be customers, key management, everything else, over to the buyer. And that time period will oftentimes be contingent upon the business, the industry, the situations, the purchase price. It's really it's not a one catch-all, but all those factors come into play. The second scenario that we've seen, which is a little bit more unique, and that is to your point, whenever there's evidence of rollover equity in a deal, and this is more common for companies where you are selling upstream to some sort of national private equity group. It's a roll-up strategy where what we've seen recently is, private equity is seemingly shifted in many ways, not all of them, where it's no longer, let's go find deals in companies that are undervalued. We can get a good deal, operate and flip in 5 years, but instead, let's just go find companies with good people, good talent, good leadership. They're just very turnkey in their operations. Let's pay a premium for them. Let's value the goodwill, and we'll make our money through economies of scale, through better spending power, through better efficiencies. Oh, and if the owner is mid-30s to 50, even better, because that they're still of an age where they're going to be active, they're going to have the energy, and we're going to keep them on board as a shareholder on the back end. And now we're going to create this kind of free agency model where we're grabbing all these good business owners and making them part of our company. Mm-hmm. And the goal is to then resell again in 5-10 years, whenever it is, and give them that chance of that second bite of the apple. I'm going to call that an earnout, because it really in some ways is, even though you're selling your business. But those are two situations. One is going to be situation agnostic company. The other one is more unique, where you're going to be fetching a huge premium for your business, and it's going to be in many cases life-changing money. Mm-hmm. But it's a big advance on your paycheck, and there are some strings attached to it. There are some handcuffs that are applied. They are very golden and they are very pretty, but that's the reality of that exit. And oftentimes that comes to trusting the buyer is going to be a good partner going forward.
Yeah, no, that's great. And when you're in that position, you've got to think about, do you trust the buyer? I mean, you need to be making a decision as a seller. Are you comfortable with the dollars you get at closing being the last dollars you see? Like, does that work for you? Because the vast majority of the time, there's going to be pretty heavy hooks in whatever that post-closing consideration is. Whether it's earnout, whether it's rollover, whether it's held in an escrow, you need to make sure that you can put all that money at risk, because it is at risk.
I'm laughing. I have a client, my favorite guys to work with ever, and he called me last year and just he had done a similar model where he had sold to a great story and had rollover equity, and out of frustration, he's like, I'm working just as hard as I did before I sold it, and I'm making more money off my investment income than my salary. And I was like, yeah, duh. What do you think they paid all that money for? He's like, yeah, I forgot. It was a good one. I'm like, hey, this is a good reminder. Like, let your money work for you. Don't work for your money. You don't need to do that anymore. But
and like you said earlier, you got to be personally ready, and you got to know what you want. Like, if you don't want to stick around and work that hard afterwards, and you want to go do other things, then you may have less value to exchange with the buyer. But you need to know that and define that up front, and be comfortable with what the trade-offs are. And that's where, guys like Sean can do a great job helping you understand how that works and what those trade-offs are going to be, and anticipating how buyers going to view that and feel about it, before you get there. Because, if you've got the luxury of a couple of years to really think about and prepare, you can change the game. Like, if you're right now you're listening and you're looking at your business and you're like, hey, if I get hit by the donut truck tomorrow, there's really not a business that survives. Like, that's a question you have to answer honestly for yourself. And if you can't answer it honestly for yourself, you need to talk to somebody like Sean. You need to make sure you've got the right advisors to really sit down and figure out, like, hey, does this survive? And if so, how? Because, like, if it doesn't, then you've got an enormous opportunity to take that time and create a ton of value for you, for your family, for your team, by just, figuring out how to fire yourself from your business in a way that makes your business better. Because you'll have more value to transfer to somebody else.
The couple mistakes, I would say the most successful, I'd say from a seller, to your point, the ones that have successful exits are the ones who are able to put themselves in the shoes of the buyer. And not view them as an adversary, but understand what they're doing, why they are approaching the things that they are, and just understanding that they're looking out for their best interests. One of those interests is to get this deal done, and to buy this company from you and gain your trust that they're going to be the right person to move forward with in many cases, your life's work. Subsequently, the business owners that I see that often the most common failure that I see are the ones who call and say, yeah, I missed my number. I missed my mark. Jake, I could have sold for a 6 last year, and now the market is now at a 5, and I'm just not going to be able to recoup that, and I'm going to miss my timing on it. Well, what if you're in your 70s?
Yeah.
What if you're in your 80s? We've seen these before. I mean, what are you waiting? I mean, not to be a jerk, but there's only so much time left that you have to sell. More importantly, if you're trying to game the market in terms of a better multiple, a buyer's going to sniff you out, because in a realistic world, the number that you're going to get, the term sheet that you're going to fetch, is going to be a direct derivative or tied to how good of a business opportunity. I mean, what the investment is. So I always tell people, just because the market, the Fed jumped, the rates went up, or it's no longer 2021 and people are, giving out massive multiples, don't you still want to sell your business? Okay, so you're not going to get a double-digit unicorn number. You still can get a good number that can be supported by good performance, a good business that has got good cash flow, growth potential, and has been de-risked. It is as simple as that.
Yeah. Yeah. And I think, to echo that, folks that chase optimizing for luck, like, perfect timing on the market, those folks I don't see a lot of them end up very happy. I mean, because you don't know. Like, unless you're really, really good at, picking that timing of the market, and you're ready at the same time. Like, you're trying to guess at things that are unknowable, but things that are knowable that can drive your value are just exactly the kinds of things that you've been talking about. How ready is your business? How clean are your books? How good is your management team? Like, are you ready? Because if you're ready and you give yourself time, you can be choosy. Like, you can look at that moment in the market where it's doing well, and you can know already, hey, here's my number that I got to have to take care of my family for the rest of my life. And I'm over that number and I'm happy with it. So let's go, as opposed to, I don't know anything and the market's hot right now. Like, how do I scramble and get out there and do that? And then you lose the power of time, and you lose the power of readiness. And as I'm saying this all out loud, I'm reminded a judge once told me, and he was a personal friend. I wasn't in trouble with the law at that time. But he told me, he's like, luck is really just preparation meets opportunity. And you get ready before you have to be ready. and you give yourself time and you have the right team, like you can do a lot when the circumstances just align. But if you're not ready and you don't have the right team, like you're guessing at stuff, and you're more likely to be in a position where you got to react to things and hope that you can squeeze it in, as opposed to being like having the luxury of being able to say like, this is a great time. Let's go. Buyer's going to love this.
Well, yeah, and the
I read a
problem is
great.
if
Go ahead, Jake.
well, I was
Sorry,
gonna say
go
it's
ahead.
like some of you just like so if you say you're not prepared, but you're like, hey, the market's hot, I'm gonna go to market, but you weren't ready for it, and you have potential buyers look at it and they're like, you're not ready for it, you're unorganized, we're gonna move on from you. Then fast forward 3 years, you're like, okay, I'm ready now because I got myself organized, I got myself in that place. Those buyers remember. They remember who they looked at, and so like, okay, what's changed? And so now the value company is, it may be higher, but they're going to value lower just because you weren't prepared before. And so it's like that's where that preparation and organization is so critical. And it's it's always I can constantly, it's like working with folks like yourself, Sean, is like constantly making that, asking them like, where am I currently at with my business? How am I being valued right now? And, in that way it's knowing where you need to be at and always preparing for that sell, even if it may not be for 5 or 6 or 7 years down the road. But if you're building your business in that way, an exit is going to happen, whether you close up your business because you didn't do the right things, you got hit by the donut truck, or you actually truly are choosing to sell your company. An exit will happen at some point in time. It's just your choice to figure out what you want it to look like.
Jake, worst case scenario, you decide you want to sell in 3 or 4 years, and you feel like there's some upside or areas for you to improve the business, starting with just better infrastructure and then moving into performance improvement. Okay, worst case scenario, you work on it, it works, you don't get it sold, but you probably have better performance.
Yeah,
You probably have
increase the
better
value of your company.
profitability.
You're making more money.
You're making more money, and guess what? Now you're sitting there with your accountant at tax time, and they go, "Hey, I think you can probably pay yourself $1 million dividend." And if your goal was to walk out the door with $5 million when you sell, well, let's just take your tab down to 4.
Yeah,
it's a great way to mitigate the risk that you're going to have enough money to retire on and live happily ever after.
Yep.
If you work on your business real time and you're able to create liquidity that then you can give to your advisor and or anyone, or couch cushion, I don't care where you put it, and it's going to be there, and it helps mitigate. And that too is then it comes time to, when you sell, it's, hey, I may not get the number that I want to get, but I'm tired of being in business. I'm tired of going to work. My spouse wants me to retire. My kids want me to retire. I'll take a discount because I don't have to get top dollar. And while there may be this, sigh of defeat, there's victory in just being done with it and moving on because you're mentally ready.
Yeah, 100%.
Yeah. No, that's great. I've got another audience question for you. This one comes from Matt Agnew. He asks if you can touch a little bit on the seller's pre-transaction responsibilities and goals that make the transaction itself go smoothly. I know we've talked about that a little bit already, but if you can kind of touch on that specifically about how that understanding of their goals and what their responsibilities are that are going to help the transaction go smoothly.
Matt's a loaded question. What is the
If
seller's...
you know Matt's has loaded questions.
All right. At the end of the day, there's going to be a lot of advisors typically tied to a deal, or there can be. Some will give good advice, some will give bad advice. Sometimes we've seen the actions of advisors impede or block the situation going forward. But at the end of the day, selling a business, that responsibility falls upon the owner. I mean, when we value businesses, sometimes people, when we value companies, we want to look at their assets. Kind of what assets do you have that are generating cash flow? Most companies, unless you're commercial real estate or you're super capital intensive, 50 to 60% of your value is going to be tied to your goodwill, your intangibles. It's how you do business, not what do I own. And we define those in the legal world and every other world as representations of management. It is on a seller to tell the story, to be able to not only present financials that are accurate, that yes, you are getting cash for revenues that you are reporting to be earning, you are paying vendors, you have the people that you say you do, but it is on you to accurately represent what goes on in your business and communicate to a buyer why you do what you do, why your business is a good opportunity. It is on a seller to communicate the good. It is also important for a seller to communicate the bad. The one thing a seller should never do is withhold information that can be easily attainable. Be transparent. Yes, you can feel very exposed. You can be very exposed when you're getting beat up by attorneys, by buyers. You can feel like you're not as good as you. Wait a second, why am I getting criticized for this? They're asking important questions to get comfort. It is nothing personal, but they have to know these answers. And sometimes it's okay. It's okay if you don't have the best margins in your business. It's okay if you have some holes. Some investors want to see that. Some don't want everything to be perfect. So maybe one buyer may not like it. Another buyer may like the opportunity. Sometimes they're saying things just for posturing purposes. But it comes down to, it is ultimately your responsibility to get your business sold and to address the risks in your business, the upside, and the overall performance, so that when you put your investment in front of the eyes of multiple parties, there is a unanimous consent that this is a good investment opportunity.
Yeah.
That's a pretty simple way of explaining it. And there's a lot to do around that. But that's what it comes down to. We can only do so much as advisors. We can help you find buyers. We can help you structure the deal in an optimal way for legal purposes, for tax purposes. We can help get your financials prepared and ready for review by sophisticated investors. What we can't do is convince a buyer that a seller's business is a great investment opportunity. It's their responsibility at the end of the day.
Yeah. No, I love that.
I mean, I think what boils down to is just that transparency and honesty. I mean, if they're going to find out, it's like, that's the thing, is don't withhold the information, is like, and it goes back to the question of like, what's their pre-transaction responsibilities, is just really have an honest conversation with yourself on, what is going on in my business that I'm going to have to really be transparent about, and more or less pull my pants down and say, hey, like, this is what's going on.
Don't pull your pants down, really.
That's a disclaimer. But it is. It's like,
don't do that. I agree.
Yeah. But it is like, there are, like, I've been in the position to where, my bank is asking me some difficult questions, and it's, they're trying to make a business decision, and they need to know. It's not like they're trying to judge you. They're just saying, hey, we need to know this information. And it's like, be able to have that emotional intelligence to know that, like, hey, I'm going to have hard conversations with people.
Yeah. Yeah. And I would echo that, the transparency element, because of course it bears repeating, because we so often see people mess it up during the deal process, where there's like some really attainable, easily understandable piece of information that the seller knows that they just don't talk about, either because they've been poorly advised or they're just nervous about it. And when you make that deal in the LOI, when you get to the deal table and that's the expectation, it is based on the information that the buyer has access to. And so if you like that number and you like those deal terms, don't expect to keep that if you've withheld some critical piece of information. Your buyer is rightly going to do exactly what I would advise them to do, what Sean would advise them to do, what Jacob would advise them to do. And they'd be like, hey, that's new information. That's bad. That's a knock on value. We got to rework some things here. Plus, if this is something that this person knew about and intentionally didn't share with you, and they thought maybe they were going to hide it or whatever, you've either got a competency issue, which calls into question all the other details of the business, or you've got a character issue. And that raises bigger concerns, because I'll advise clients all day long, unless you have no other options, don't do business with people you don't trust. I mean, especially when you're tying up a ton of consideration for, post-closing payment. Like, if you don't trust these folks, with this deal process, why would you trust them with your legacy, with your family name on your reputation on that business, with your employees, with your customers and all that other stuff, let alone the money that you're going to hope that they pay you after closing?
It's the trust is the most important thing, Sam. We talk about value drivers in a business, but we think about the elements of value within a deal. I like to call it, you have the three T's. You have your terms, what's your price, what's your structure, what are the terms of the deal. There's your taxes, which could argue as part of a transaction, but they're my T's and I want three of them. So it's taxes. They're important.
Yes. I like
and
your
then
style.
the third, and thank you. And the third one is timing. We oftentimes forget that when you can't accurately, when a deal falls apart, it can take, you got to find a new buyer. You got to go under close. You got to go through the song and dance. You got to get through a letter of intent. You got to go through it. I mean, it can be a 1 year, 2 year setback. And just think about time value money on earnings, not just on top of just suppressed margin, and also not to keep working at my business. I have to make sure that I'm still performing well. I just mentally relax, and now I have to get back into it. And those three T's are all intertwined around the fourth one, to your point, which is trust. If a buyer doesn't trust a seller, a deal will never happen. If a seller doesn't trust a buyer, that won't happen. And oftentimes, too, that's a good litmus test. And to be honest and forthcoming, I was thinking about Jake, for example, owning Orange Theory. And if Jake were to have hypothetically sold Orange Theory in 2021, and
made a lot of money,
and the seller said, "Hey, what happened in 2020?" And he's like, "I don't know what you're talking about. We did great." And it's like, "No, COVID, you were shut down." He'd be like, "Hey, 20 was a rough year, COVID, social distancing, they couldn't come work out at Orange Theory." Well, it's also a buyer should go, the right buyer's going to go, "Yeah, because the franchise that I run also had that problem," or yeah, not a big deal. We expected that. So in many ways, like being upcoming and forthcoming with bad news, or being about maybe blemishes in your business, there's a good chance that the buyer, like they shouldn't, the right fit shouldn't be surprised.
Yeah. And if they are, then there's an opportunity to engage and educate them about how to understand it in that context. And way better to know that as early in the process as possible, because that sunk cost is a real thing. And if you're an aging seller, you may not have time to go repeat the process, and you might be stuck at that deal table because that's the only option you've got. And now your buyer's renegotiating that, and they're wanting to carve 20% off your purchase price. And there goes the trust funds for your grandkids, right?
Don't give buyers,
probably let the boat go first.
Don't give buyers additional reasons to negotiate in their favor.
Right.
It's one thing if they're being unscrupulous or unethical, or if they're playing or if they are lying about their capacity for funding or anything else, because we do see that quite often.
Right.
But avoid the unforced errors.
Yeah. 100%. Well, Sean, we really appreciate your time and sharing your experience, your expertise, and your wisdom with our audience. We'd like to close with kind of two questions. What's a great tip that you have for buyers, and what's a great tip that you have for sellers?
I'm gonna be selfish here, and I'm gonna say for buyers and sellers. And yes, I have a personal and financial and professional incentive to say this, but there's a reasoning for it. Don't do it alone. This is not M&A is not cheap. It is not a cost. It is an investment. And I think a lot of people are confused or forget that this is you're investing in an investment. And for buyers, I've lost count of the number of times where they've been uncertain about spending maybe $15,000-$20,000 to assist with buy side diligence, and I'm sitting here thinking, you're about to take out $4 million in debt. That's
you're literally going to mortgage your family's future.
You're not going to invest in one extra month of debt service to get a better understanding of what you're getting into. You're not a good fit for all parties. I don't, and I get closing costs and I get the funding piece of it, but I see that on the buyers, and it's the same thing with sellers. Jake, how many sellers are like, I don't want to hire an investment banker. I don't want to pay them X%. I'm like, why would you not entertain someone? I go, who can find you a good fit and get this done, and then do it for you.
Yeah. Sean, I want to talk about this a little bit more because I think it's so important for people. And we bump up against it all the time with buyers and sellers. Is like they're new, right? Like if this is your first time buying or selling a business, I mean, everything's new for you. And I feel like part of the challenge is that people are coming with the assumption that the amount of value that can be obtained from the transaction is already somewhat predetermined. And so the levers that they have to pull on to increase value is like, well, I control my costs. Instead of thinking about it from the perspective of, hey, this is a value creating, event where if I bring the right preparation, I bring the right team, to the table, I can change the amount of value that can be obtained. And so just to your point of investment, it's not something where, you change the amount of value necessarily by controlling your costs. It's something where your focus has to be on like, hey, what is the value that I'm really trying to create here? And sometimes it's not all monetary, but a lot of times that's on the scorecard somewhere. And then how do I get a team that's going to help me create as much of that as possible? Because like I can think of many instances where like the right sell side team running a good process has created, many times more than the value that they consume. I mean, because the numbers change. They're literally not the same numbers. It's like,
they're
sorry,
constantly moving.
this is a soapbox for me. Like, make more value out of your deals and keep it.
And yes, look, is this a promotion for services that we get
Sure.
paid for? Yes, but we wouldn't be in business if there wasn't a true ROI on the value that
100%.
we can create.
Right.
Whether it's Jake making the right introductions to the right people who can find the right buyer, who can get the best price for their business that is fair and can ensure that the transaction will be done, and that all parties walk out and they're happy with the terms and circumstances. It's company, it's Sam, it's investing in legal protection and making sure things are properly structured the right way because of all the risks that are unidentified. And then on our end, it's focusing on the financials and the accounting and just making and then working on in that crux plus the tax piece as well.
Right.
I always think back to most people have never bought or sold a company before, but have you bought or sold a personal residence? Fundamentally, it is a very, very similar process. And I can think of, some people have had bad experiences, but, I can think of myself where, yes, I've sold some homes before where I could have sold by owner and avoided paying a realtor, but we hired the one that we trust, that we valued, and they gave us good advice on what to invest in our home prior to sell. Get new countertops, get the kitchen, you will accelerate this. Then they found a better price that we wouldn't have gotten had we sold as is. And they did all of it while we were out of town. And so there's convenience, advice, and value prop. And that alone, I'm like, you could have charged me double and I would have come out very, very well. And it's very similar in theory to when you're buying or selling a business. It sucks. It is expensive. It is time consuming. It is stressful. It is lonely. Don't do it by yourself.
Yeah.
Get a team, treat it as an investment, and hold your investment team accountable for their actions. And
100%.
Good things will typically happen.
Yeah, 100%. Because a good team is, they're not just going to be there for the payday. They're going to be there because they care about helping you get great outcomes. And I think that's one of the beautiful things about these processes is there's multiple opportunities to align the creation of value. All of the people that have an expense item on the deal team have a responsibility to create great value through the process. And when that lines up, beautiful things happen. So, Sean, we really appreciate you taking your time today and sharing your experience, your expertise, and your wisdom with our audience. We're really passionate about partnering with the folks that are listening here to help build and transition the businesses that build thriving local communities. And we know that this content is really helpful on that front. And we're grateful that you've taken time today to help us in that endeavor.
No, I appreciate you guys having me. It's been a blast. I've had the luxury of working with both of you, both on a personal level in the professional space, and just getting to know you guys the last couple of years has been really, really rewarding for myself as well. And this is fun. I'm very honored to be here. And thanks again for having me. Appreciate it.
Thanks, John.
Appreciate it.
Thank you for joining us today. For future episodes, please subscribe to the podcast on Apple Podcasts or Spotify. And please check out our website at www.goforemanlaw.com/learning.